Hello, my fellow investors. In the last part of this series analysis, let's get to the current position of the company and what's the right price to buy the stock. So, first of all, we have to ask ourselves a question. Is the passing of Ken Taylor going to be a major effect on the future of the company? So, of course, Ken Taylor opened the company, it was his company, and of course he cared about it much more than other people. We could see over here in the 2021 annual report. So the being over here, Ken Taylor passed away, and the new CEO is Jerry Morgan. He became the president and the CEO. So of course, it's not the same thing when someone who opened the company and he cares about it much more than someone else. But all their managers are people who grew up in Texas Roadhouse. They all have 10, 15, 20 years of experience. They all grew up in Texas Roadhouse. I think Ken Taylor implemented the DNA of Texas Roadhouse so strong in all his employees. He was going around from place to place. Everyone knew him. I don't think it should be a major effect. That I don't think it's a risk. That's my opinion. And we see the market didn't either think it was a big risk that he passed away, and he's not running the company anymore. So my next question would be, what's the worst case scenario and the best case scenario for the company for the next 20 years? So the first thing we'll have to ask ourselves, what about inflation? So I just want to point out something. This is the annual report from 2004. And it says the per guest average check for the restaurant we owned and operated in 2004 was $13.72. So the average check of a guest was $13.72. And over here in the 2021 report, so this is 20 years. I mean, there wasn't high inflation the past 20 years, but it was. The per guest average check for the Texas Roadhouse restaurants we owned and operated in 2021 was $19.68. So more or less, the prices went up in 50% in the last 20 years. And if the average person is paying $20 per guest, if a family of four come in, so if it's 4 adults, then it'll be $80. If it's 2 adults and 2 children, so it'll probably be something like around, I don't know, $50, $60 for a family. Even if the inflation is 10% and the prices go up in 10%, so it'll be another $5, $10. People come once a month to the place. I don't think inflation is such a big risk. I don't know. It doesn't seem like such a big risk. It's not like expensive stuff that people can't afford. And we could see, we saw in the companies in the 2009, in the financial crisis, the hardly went down, and the revenues went down to $1 million. The company was still earning money. Only COVID hit the companies very hard because it's casual dining. So I don't think inflation is a big risk. That's my opinion. So what's the worst case scenarios? I think the worst case scenario for Texas Roadhouse is like every other restaurant. If the company forgets its concept, if the company forgets what's the DNA, what they are, and they start looking for changes, I think that's the biggest risk for every single restaurant chain. That's my opinion. I think that's the biggest risk. And I think this risk is not a big risk in Texas Roadhouse, where everyone they don't want to change. They want to keep everything new. They're not changing Texas Roadhouse. They're just making new concepts, but they're leaving the old one the way it is. They're trying to look for new lanes of revenue, new vehicles of revenue, but they're not changing their main concept. So I don't think this risk is too big of a risk. Well, of course, a recession I don't think is going to hit the company too hard, like we saw in 2009. If there'll be a Great Depression, that'll be catastrophic for everyone. So unless, of course, we can never know. Okay, so the big question is, what is the right price to buy the company? Now, we can analyze the past 20 years, but it's very hard to know what's going to be in the future. So I played here out 3 scenarios about the future. And first, let's analyze the past 20 years. So in 2003, the net revenue was $14 million. And in 2021, the net revenue was $245 million, which is a compounding annual growth rate of 15.94%. And something interesting I just want to point out, and that's I put it 2003, the net tangible assets in 2003 was 146 million, and in 2021 was 2.3 billion. And it's very interesting that the net tangible assets were compounding at almost the same exact amount as the net revenue. I'm just pointing this out. Now, if someone would have bought the company then at a P of 1, so you would have just bought the company as is at $14,764,000. sold it after 20 years, 19 years, whatever, at $245 million, he would have compounded at 15.94%. Same thing, if would have bought at a P of 10 then, 147 million, sold at 2.4 billion, he would have compounded at 14.94%, same exact thing. Then the company had 162 locations, and today they had 587 locations. So can we assume that if the company in the past 20 years is compounding at around 16%, that if I buy in now, or continue to compound at 16%, that is, we have no indication and no reason to believe it's going to be the same thing. The company then was a small company, it was growing pretty fast, and we have no reason to believe that it's going to continue to compound at the same rate. So what we have to do is try to evaluate the most conservative scenario that's going to be the next 20 years, and have whatever we want to bet or to assume or predict what's going to be the next 20 years. By that, we could decide at what price we're willing to buy the stock. So what I did over here is like this. Scenario 1, only Texas Roadhouse concept succeeds, and the company is building 30 new company locations per year. So we're taking out all the franchises. We're just looking at the company. We know the company is, for the past few years, is growing every single year by around 30 more locations. There's no reason to believe, it would be a pretty safe assumption to predict in the next 20 years, the company is continuing to grow at 30 locations each year. And what I mean, it's Texas Roadhouse or with a little bit of Bubba's, but we're excluding a major success of Bubba's. Mainly Texas Roadhouse, maybe a few Bubba's also. The company is continuing to grow. We know it still has another like 200, 300 locations in the United States and also globally, where it's a pretty safe assumption in the next 20 years, another 30 locations. That means 600 new locations in the next 20 years. So if the company is opening 30 new locations each year, that's 600 locations in the next 20 years. So today they have about 600 locations, company locations. And so in 20 years, they'll have 1,200. So that's, you see a difference in compounding at 3.8%. It's lower than they were in the first 20 years, which they were compounding at 7%. Now let's assume they're going to compound only at 3.8%. So here's a big question: how much is the net revenue going to be per location? So we're assuming a pretty safe assumption is going to be 1,200 locations in the next another 20 years. The question is, how much is going to be the net revenue? So we know that today the net revenue per location is at least 390,000. And as I pointed out in the part 2 of the series, where I made all the calculations, how much is the net revenue. And as we could see in 2004, the net revenue minus the royalties per location was $46,000 per location. And in 2021, it was already $390,000. So the company, it was eightfold went up the net revenue, besides the royalties. Net revenue for per company location went up eightfold in the last 20 years. And it wasn't because of inflation. As we saw, the average price per guest went up only 50%. But the net revenue per location went up eightfold. But the question is, can the company continue to grow at such a pace? That's very doubtful, because the reason the companies grew is because their places became more, they make each prototype a little bigger. They're taking over franchises locations, and they made them even better. So let's make a conservative assumption that in 20 years, their net revenue per location will go up from around 400,000 to 1 million. That's just a pretty safe assumption, and just inflation alone would probably take up the net revenue per location to around $1 million. So if they have 1,200 locations, $1 million net revenue per location, so they're going to be earning $1.2 billion per year on the company. So we're taking franchises aside. We don't know what's going to be with the franchises. So the total revenue will be $1.2 billion. So soon we'll make a calculation, how much is it worth it to buy the company. So as for now, the company has... just let me put this aside. So as for now, the company has 70 million shares. So if we're taking aside the stock market, what's the stock market price in the company? We're just making a pure valuation. So we're valuing the company, let's say, at a PE of 10. So the company, we said, was earning a total revenue of, in 2022, of $245 million. So at a PE of 10, the company is worth $2.45 billion. Divided to 70 million shares, so that's $35 per share. So we're assuming now, at a PE of 10, that the company is worth the value of the company is worth $35 per share, or that's exactly earnings per share, $3.50. That was the 2021 earnings per share with $3.50. So if we're assuming that in 2042, the company would be worth $12 billion, and we're assuming the same amount of shares, 70 million shares, so the company would be worth in 2042, $171, which will be compounding at about 8%, 8.2%. So if I buy the company now at its value, and I'm assuming the most conservative assumption that the company is going to have 1,200 locations, each location will be earning $1 million per year, so the company would be worth $12 billion, which would be $171 per share. If I buy it now at the value, I'll be compounding 8%. If I buy the company, the stock price now, at $5, which is a P of like 1.5, then I'll be compounding at 19%. So I'm taking, again, I'm buying the company as its value. I'm valuing it now at $2.5 billion. I'm buying each share for $5. In my safest assumption, the company would be worth $12 billion in 20 years, which would mean $171 per share. I'm going to be compounding at 19% per year. If I buy the stock at $10 now, I'll be compounding at about 50%. If I buy the company at $15, I'll be compounding at about 13%. If I buy the stock at $50, then I'll be compounding at about $6.3. So now the stock price is around $100, so the chance of it going down to 5 is pretty slim. So this is scenario 1. Now I'll take scenario 1 to what happened with the franchises. So let's assume for a second that the net revenue per franchise would go up from to $500,000. So as we calculated in over here, the royalties, sorry, not the net revenue, the royalties per location that the company is going to get is going to be $500,000 per location. And as we showed over here in the royalties per location, and again in 2004 it was $102,000, in 2021 it was $245,000. So this, we know that how much, it's at least this amount because the company is taking 4% of net sales. We know exactly how much the company is getting in the average per location. So let's assume that in 20 years it's going to double, and the royalty per location is going to go up to $500,000, which would be assuming that each location would have sales of around a little bit more than $10 million, which isn't too far-fetched. We heard Ken Taylor say in an interview that the location in Dubai is making $13 million today. Assuming that the average location in another 20 years would be making $10 million of sales, that doesn't seem too far-fetched. So the total royalties would be $150 million, and the total revenue of the company, which would be the $1.2 billion from its locations, plus the $150 million from the royalties, would be $1.35 billion. Again, that's compounding at 8.8%. So again, if I buy the company, if I'm valuing the company now with its franchises at almost $2.7 billion, that's $38.47 per share. And if I'm assuming that in 20 years the company would be worth $1.35 billion, so in 20 years at a P of 10, it'll be worth $13.5 billion. That'll be $192 per share. Again, compounding at about a little more than 8%. So again, if I buy the stock at $5, and this scenario turns out that the company has 1,200 locations and another 300 franchises location, we're assuming that there's 10 new franchises per year. We have no idea if that's going to happen or not, but let's say there'll be another 10 franchises per year, and today it has around 100, so they have 300 franchises in 20 years. We're assuming the valuation of the company will be $13.5 billion. Again, if I buy the stock today at $5, and that's what's happened in 20 years, I'm going to be compounding a little bit more, 20%. Over here it was 19.3, over here it's 20.03. If I buy the stock at 10, I'm going to be compounding at close to 60%. If I buy the stock today at 15, I'm going to be compounding at around 13.6%. If I buy the stock at 50, which is half of what it's worth today, more or less, so I'll be compounding close to 7%. Now, this is probably the most safest assumption in mitigating any risk. Probably, this is pretty safe to assume that's going to happen. But let's just, for the sake of this, what happens if the company doesn't earn a net revenue of $1 million per location, but it earns $2 million per location? So this is what's going to happen. The company would be worth in 20 years $24 billion, which would give it a value per share of $342. If I buy the stock at 5, I'll be compounding at 23.5%. But if I buy the stock at 50, again, I'll be compounding only at 10% per year. And if, let's say, we'll assume that the royalty per location would be $1 million, so we're assuming each location, each franchise would be selling at $20 million per year, or maybe the company takes up the royalty fee from 4 to 6% or something. So again, so in 20 years, I'm assuming the company would be worth, wait a second, I need to change this also. It would be worth $27 billion, which would be $385 per share. If I buy the company at $5, it's 24%. If I buy the company at 10, it's 20%. If I buy the company at 15, it'll be 70%. If I buy the company at the stock at $550, I'll be paying about 10%. So let's continue on to scenario number 2. Let me just change it back. Scenario number 2. Scenario number 2 is the Texas Roadhouse and Bubba's concept both succeed. And the company isn't only opening 30 locations per year, but the company is opening 60 new company locations per year. So it'll be 30 new Texas Roadhouse and 30 new Bubba's per year. Today they have 587 locations. So we're assuming that it'll be 60. It'll be 1,060 times 10, 600 is 1,200, 1,800 locations in 20 years. They have today 600 locations more or less, plus another 1,200 to 1,800 locations. Assuming that the company will be earning a net revenue in 20 years of $1 million. So the net revenue will be $1.8 billion. Again, saying everything was the same exact thing. The company will be worth $18 billion in 20 years. At 70 million shares, it'll be $257 per share. If I buy the stock today at $5 and this scenario goes out, I'm going to be compounding at 21%. And everything here is the same thing. If I buy the stock at $50, I'll be compounding about 8.5%. And again, if I'm assuming franchises would be also 300 locations, $500,000 per royalty per location, so the company will be worth $19.5 billion in 20 years. If I buy the stock at 5, I'll be compounding at 22%. If I buy the stock at 50, I'll be compounding at close to 90%. Let's say, for the sake of argument, that the company would be earning $2 million net revenue per location. So we get like this. The company would be worth $37.5 billion. If I buy the stock at 5, I'll be compounding at 26%. If I buy the stock at 10, I'll be compounding at 22. If I buy the stock at 15, I'll be compounding at 12, almost 20%. Now this isn't, I don't think it's too far-fetched. We saw also in the person who got the manager of the year in 2021, the net revenue per location was $2 million today. Okay, so that was the best location in the company. But I don't think it's too far-fetched to say that in 20 years, the average net revenue per location will be $2 million. That doesn't seem so far-fetched. And let's say also the net royalty per location would be $1 million instead of $500,000. So we get a valuation in 20 years of $39 billion. The value of each share would be worth $557. Again, assuming there's no dilution in the stock in the amount of shares. So again, this is scenario number 2. Texas Roadhouse succeeds, Bubba's also succeeds, and the company builds up an entire process of opening up 30 locations for each concept each year. Is it possible? Yeah. You can't say no, but you can never know. It's not something that's going on now that we could be so sure it's going to happen. We know Texas Roadhouse is growing at an average of 30 plus locations per year. We can't be for sure that it's going to be growing also Texas Roadhouse and also Bubba's in 30 locations per year. So let's continue on to scenario number 3. Scenario number 3 would be that Texas Roadhouse and Bubba's and Jaggers concept, all of them succeed. So the company will be opening up 30 locations of Texas Roadhouse, as it is doing today, 30 locations of Bubba's, and let's say this is something we have no idea what's going to be with Jaggers. We don't even know if it's going to succeed yet. But let's say it's going to succeed, and the company is going to be opening up 30 new locations each year. So the company locations of Bubba's and Texas Roadhouse will be 1,800 locations. Let's say, assuming a net revenue per location of $1 million, and Jaggers. So assuming, let's say now they have 5 Jaggers in 2022, let's say they're going to have 600 Jaggers. And let's assume that the company's net revenue per location would be $100,000. Why am I taking this number? I have no idea, because I have no idea how much to assume they're going to earn. I know that Chipotle, which is a very successful restaurant, is a fast food restaurant, is earning at around $250,000 per location. So I have no idea how much Jaggers is going to earn. But let's just assume $100,000 in another 20 years, they'll be earning $100,000 per year. That's just a wild guess. I have no idea if it's true. So the company will be earning $60 million on the 600 locations of the Jaggers. The total revenue in 20 years would be $1.86 billion per year, which is compounding at 11.25%. So assuming this scenario goes out, the company's value today is $2.45 billion, and in 20 years it'll be worth $18.6 billion. The value per share would be $265. Again, if I buy the stock at $5, I'll be compounding close to 22%. If I buy the stock at $10, I'll be compounding close to 70%. If I buy the stock at 15%. If If I buy the stock at 50, which is 50% less than what it is now in the market, I'll be compounding 8.7%. Now, let's assume the company would be earning $2 million net revenue per Bubba's and Texas Roadhouse. And it'll be earning $200,000 per Jaggers location. Not $100,000, but $200,000. The company's valuation in 20 years would be $37 billion. At 70 million shares, each share would be valued at $531. That's a P of 10, yeah? So if I buy the stock at $5, I'll be compounding 26%, at 10 at 22%, at 15 at 20%. If I buy the stock at $50, I'll be compounding at 12%. And let's even assume that the royalty for a location would be $1 million instead of $500,000. Again, we just get a little bit of a better number. The value per share would be $574. And if I buy the stock at 5, it will be compounding at 26%, 26.7, at $10 at 22, at $15 almost at 20%, and at $50 will be compounding at almost 13%. Can we know what's going to happen? No, I can't guess it. I have no idea what's going to be with the company. I'll be pretty safe to assume that Bubba's is going to succeed. But again, how much locations is the company going to open in the next 20 years? I have no idea. Is Jaggers going to succeed? I have no idea. Maybe the Jaggers will be such a major success and they'll be opening up 60 locations a year. I really, really doubt it because it's so much the difference of Texas Roadhouse isn't such a kind of a company that's looking to go very, very fast. They're very, very conservative. They're very, very stable. So I really doubt. I don't even doubt. I mean, it'll be very hard for me to assume that the company will be opening up 60 locations of Jaggers each year. But you can never know. Whatever it is, I don't see any way that buying the stock right now at $50 is going to be compounding above 10%. It seems very unlikely. So you have to also decide how much you want to compound. I'm looking to compound at 20% a year. So I don't see myself buying the stock at a lot above $5, which is 95% less than what it's worth today, the stock. It's not what it's worth, but it's what the market is pricing it. So again, I think it's a very, very high quality company. This is the kind of company I would want to own, but you have to buy it at the right price. It's not a fast grower. It's a good company. A good company you want to buy it at a good price. To buy a good company at a fair price, you're probably not going to be compounding at a very, very high rate. Again, now what would happen if the stock price would be valued in another 20 years at a PE of 30? So of course, then you'd be compounding at a much higher rate. If you buy the company now at a PE of 30, and you're going to be selling it in 20 years again at a PE of 30, so you're probably going to be compounding about somewhere around 15%. That's more or less what the company is compounding. You can just make the calculation. Let's just assume for a second, over here we're doing a value per share of $574. So this is at a PE of 10. But let's say we'll do the PE of 30, which would be times 30. So we'll do $1,500. Let's say. So if the company, let's say the price of the stock market would be pricing each share at $1,500 in 20 years, not at $100. If you buy the stock at $50, it would be compounding at close to 20%. Again, that's already speculating. We have no idea what the company is going to be, what the market is going to be pricing Texas Roadhouse another 20 years. But if the market is going to be pricing Texas Roadhouse at a value of, at a P of 30, and let's say this scenario is going to play out, that the company is opening up 1,800 locations, 600 Jaggers locations. If you buy the stock at $50, you'll probably be compounding at, you're not going to be compounding, they're not the value of the company, but the stock price will be compounding at about 19%. If you buy the stock at $100, that's where it is today, and in 20 years, the stock price would be $1,500, you'd be compounding at 14.5%. Well, it's not bad to compound at 14.5%, but again, you're assuming that the market is going to value the company at $40 billion in 20 years and a P of 30. You can never know. That's already getting to speculations. I'm not a speculator. I'm a value investor. I buy by value. I sell by value. I'm not speculating what the stock market is going to do and going to value the company in another 20 years. So I hope you enjoyed this whole video. And if you liked it, I'll be happy if you give me a like. If you like my videos, I'll be happy if you subscribe to my channel. In the next video, I'm going to make a short conclusion of the whole series. I always like to, like Peter Lynch says, to make to explain the whole entire story why I like this company in a few minutes. So thank you very much and hope you enjoyed this video.